All right, it is Sunday, September 25th, 2022. This is all about your Benjamins and your weekly mixtape and weekend review video. And we're going to go a different angle. There are no articles down below this over on the blog. We're going to talk about the elephant in the room and the markets and the economy. And we always hit on these things, but I always try to find other areas to bring in because I don't want to focus always on the markets and investing, the economy. Those are all important things of our financial plan, but as a financial advisor, it is one area of what I'm looking at and thinking about with my clients. It's an important area, but I think sometimes it gets too much focus, so I don't want to feed that focus and make it seem like that's the only thing that matters to clients and matters to a financial plan. But with the last week and the headlines being really negative and seeing a lot of people who have been optimistic starting to doubt their optimism, I think it's time to spend a little bit of time addressing what's going on from my perspective and what I'm thinking about with my clients. Truthfully, this video is really for All This Wealth clients. I'm just putting it on the blog for everybody here as well, but this will be the first thing they'll see in the rundown that they'll get later on this afternoon, the weekly email we send out to clients. So there's no way around it that 2022 has been a sucky year in the market. Excuse my French. It's not been a good year. We've had a lot of ups and downs and volatility, and after this last week, we're right back down to the lows of the year. So I've got a chart that I'll throw up that's got the ETFs that represent the main indexes in the U.S. I didn't even pull international in, and they're all down. Two of the three at bear market territory, 20% down. One of them right there. So the Dow is almost at bear territory. The S&P 500, the NASDAQ are both in bear market territory. And we've bounced around, we've come back, we've given it all back. And now September is historically one of the worst months of the year. All these theories why, but nonetheless, September is already a volatile month. And then you add in a year of a war, you add in inflation, you add in interest rates going up, you add in coming in off of a multi-year bull run, and it's just this recipe for September continuing the trend of being negative and volatile. So we've seen that. So what happened this week that really kind of turned things, and you've seen people kind of losing their cool on TV, is the Fed raised rates another 75 basis points, 3/4 of 1% point going up on the Fed funds rate. So we knew that they were going to raise rates, and the expectation was it was going to be 75 basis points, but the Fed continued to have very strong language that they're going to continuing to raise interest rates no matter what happens to the economy. So the narrative now that we're seeing out and around the social media world and in the media world is that the Fed just doesn't care about what happens to the market. They don't care about what happens to housing, that they're going to wreck the economy if they have to bring inflation back down. And that is part of their job, is to get inflation under control and prevent inflation from getting out of control. So some of the people who are speaking out against what the Fed is doing is that they're blaming the Fed for getting us in this position in the first place. And there's some truth to that. Jeremy Siegel is one of the people who I saw this week go off on CNBC. If I could link to it, if I was talented enough as an editor, I would have that video come up now, but I don't know how to rip it off of YouTube or CNBC to put it in there. So Google Jeremy Siegel. He's a very respected professor, has been in the business a long time, and back last year, he was warning that the Fed was doing too much. They continued to buy mortgage bonds, they continued to make interest rates low, they continued to put more money into the system when it was clear that the economy had gotten by COVID's risks. The economy was in good shape, and there was no reason to continue to keep rates low and keep the economy afloat because it was doing it on its own. They continued to put money into the system, and the only thing that can come from that now later on is inflation. Well, what was frustrating Professor Siegel is that he believes now, with the raising of the interest rates and committing to doing it, they're going to do they're going to do the same thing but on the opposite end of the spectrum, meaning they should have quit buying, they overdid it on this end, and now they're going to overdo it on this end, trying to bring inflation back down, causing more harm than good. And what I think people want to see is just, okay, we've got inflation coming down. It looks like it may have peaked. We're seeing gas come down, other prices come down, housing is coming down. So we're seeing that what the Fed wants to accomplish is beginning to gain traction. Maybe we just pause for a moment and see if the raising of the rates that we've done is going to kind of allow inflation to correct itself without more interest rate rises coming in the future. And I think that's what some people are looking for, but the fact that they're committed to doing it no matter what, and basically just saying, we don't care about the market, we don't care about real estate, we're going to do what we need to do to get inflation back down to 2%. They've got a goal of around 4% by the end of the year. We're in the 8s right now. It's really, really aggressive. And the fear is that aggressiveness is going to have a hugely negative impact on the economy and the stock market. It'll spill over to the global, because it's not just our Fed. Other banks across the globe are raising interest rates as well. So you've got this unified raising of rates across the globe, which will slow down economies, understand what they're going for, but are they doing too much all at once, just like they did too much in the past? And obviously, it's very easy to look back with hindsight and say, hey, you should have quit buying those mortgage bonds, you should have quit putting money in there, you should have started raising rates earlier. It's very easy to play Monday morning quarterback and talk about what they should have done. However, they're in a position because they're supposed to be the ones that are forward thinking and understand this. And it got to a point, my friend Josh Brown wrote a great blog post that's going to be down in the links below, talking about how everybody saw this recession coming. Everybody saw, there's rappers talking about it. And again, hindsight, don't take it away from it, but these are the professionals that are supposed to be ahead of the curve and knowing more than everybody else the best suited people to do this. And it looks like they did a bad job of it now. And it looks like they're going to do a bad job of fixing it, which impacts all of us in the short term. And that's what I want to focus on as well, is that yes, right now stinks, but there's a chart that I love that I've been using a lot in client meetings. So if you're a client, you've probably seen it. And if we haven't met yet, you're going to see it. This chart that I'm going to put up right here from JP Morgan's Guide to the Markets. And the reason I love this, you can just strip out the numbers. I don't even care what the numbers are on it. It's just the visual representation of what the market does pretty much every year. So 40 years of market history. It shows you where the market ended. It shows you where it went, up and down. And you can see across the bottom pretty much every year we spend some time in the red. That's why financial advisors stay the course, don't sell, don't panic. We know there's going to be volatility in year to year. Very few times is the low of the year where we end up. So you can see on that chart, we go down, but most of the time we finish higher than that low. Sometimes it's positive, but sometimes it's still negative. So just because we're down, and this is one of the worst years we've had in a long time, and the worst year for a 60-40 portfolio, which I'm going to talk about here in a moment, it doesn't mean we're doomed to end that year. If things continue to go as they've been going in September, it might get to a point where investors in the market decide, all right, everything bad is priced in. We know the Fed's going to be really aggressive. Let's start, the value is there in the market. Let's come back in. And I don't think that we're going to see a V recovery like we've grown accustomed to with the low interest rates. There's competition now for dollars. The reason you saw the V snapback in the past was that where else were you going to put your dollars? You've got cash earning nothing. Where else are you going to invest? Now, today, you can go invest in bonds. Municipal bonds have good rates now. Savings rates, even though they're not keeping up with inflation, I have a lot of our savings, personal savings at Ally Bank. I got an email this week that I can earn 3% on my cash just sitting. So now when you think about people who are afraid with the market, they can have their money earn 3%, even though the real return is being eaten up by inflation. There's the perception of, well, why would I go be in the market and be down 18, 20% when I can sit and get 3%? 3 is better than losing. So there's competition for where dollars can go, which makes the stock market not the only place to park money. And you take crypto out of the market as well right now. Nobody wants to talk about crypto, which I think is the perfect time to learn about it and educate yourself on it so that when another bull market comes in that area, you understand it before you hop back in. That's a sidebar for another conversation. We're just focusing on the stock market. But I bring that up because last year, that's where people were putting their money. And in hindsight, we can see that was the euphoric state that we talk about at a market top. It was crazy what was going on. And there were some things in those moments where you realize that, a $10 million JPEG of a rock is probably not where things should be right now. But to see things go from 0 to 100 as quick as they did, we started the year with low inflation and then we went up to 9% really quick. And now it's starting to slowly come back down. But the way things accelerated this year, I think was wild. Looking back, it's just amazing to see what we've seen this year. And all while that's happening, the job market still appears to be relatively strong. So what does all this mean? So kind of just a snapshot of where things are, what happened this last week, and what really I think turned the tide, or turned the tone of what people were talking about to being way more pessimistic, was the raising of the rates, which we expected, but the language and the commitment to do it no matter what it means to the market. And we'll have to see if they stay true to it. Maybe things get bad enough that it makes them pause and say, hey, we're going to not wreck the market anymore. We're going to see what happens before we go forward. I mentioned 60-40 portfolio. The 60-40 portfolio is the portfolio that we've all been taught about. Diversification, stocks to bonds, 60% equities, 40% bonds. That's been a portfolio that for the most part has been deemed to be relatively safe to hold for the long term. And it still will be, but this is the worst year in history for the 60-40 portfolio. Because we've talked about the stock market right now. What's going on also, the double whammy that you're feeling, is the bond part of your portfolio is down probably significantly as well for bonds, depending on what type of bonds you're holding. Short-term bonds, you could be flat to up maybe a little bit this year, or down a little bit. Intermediate, down a little bit more. Long-term bonds getting smashed. The reason for that is, we know bonds and interest rates have an inverse relationship. We've been taught that. When interest rates go up, bond prices go down, because if you're holding bonds that are longer term, that are locked in at a low fixed rate, the only way you're going to unload that to another investor is you're going to have to discount the price. Think about it. If you're trying to sell a bond for $10,000 that's yielding 1%, and you go to the market, you want to get your money back, and somebody in the market can go get a 3% bond for the same $10,000, I'm not giving you $10,000 for 1% when I can go give $10,000 for 3%. So the only way for me to take your bond, maybe I would do it because the term to it is almost done. The only way I'm taking your 1% bond is if you sell it to me on a discount. So you have to decrease your price of the bond to be able to sell it, because the going rate for interest rates are higher. So that's why we have that inverse relationship. So the area of the bonds, depending on why you invest in bonds, for me, portfolio construction, the reason for bonds has been safety. When stocks go down, bonds should hold or if go up. We want something that's going to zig when something's zagging. Well, both of them are zigging this year because the market's coming down. The stock market's coming down for the reasons we discussed, and then the bond market's going down because interest rates are going up, and you have both parts of the portfolio. Now, if you have a diversified portfolio, your 60-40 portfolio is still better than if you were 100% equity, depending on the equities you hold, just kind of generalizing. But if you were 100% S&P 500 versus 60-40, your diversification is still helping you, but you're down more than you're probably used to being or would have expected because of the bond part of your portfolio. So one of the things I'm looking at is, are there areas within the bond portfolio that make sense to have changes? So for RLS Wealth clients, especially the retirees in this component, we've got a portfolio that drifts. And that drift has had us the most conservative portfolio we sit in. And when it's sitting out of the market in our tactical part of the strategy, it's in short-term bonds. So the majority of the bonds we're holding are the shortest term, meaning they're turning over faster. So they're either able to weather the rising interest rate environment better, because if you think about it, as that bond comes due, now we can buy bonds in the rising rates and we can roll them over faster. Think of laddering CDs as the same exact thing. So we are on the short end. We have a little bit of intermediate, and evaluating, does it make sense to continue to hold those or shift everything to small, or are there other areas to go to? Those are what financial advisors are focusing on. For me, I am less concerned about the equity side of client portfolios and focus more on the fixed income of, are there things I should be doing differently because of the change in the environment in the bond market. The 40-year bond bull market is over. We've been blessed. I mentioned the reason we invest in bonds is for safety. Well, the last 30 years, 40 years of investing in bonds, you pretty much got that safety component, but you also got returns because of the interest rate market and the bond market. Well, that has changed. So do we need to be making changes, or do we continue to sit and hold the portfolio as we always have, remain disciplined, and really just manage the cash flow of client portfolios on the way out? So those are the things that, as an advisor and investment advisor, I'm looking at, trying to look at. I have the utmost faith that the stock market's going to recover. We've been through 2008. We've been through 2020. There's been 2017, 2018 have had some pockets in there as well. I believe that the market's going to recover. Being globally diversified across thousands of companies across the globe, I've got the utmost faith those markets are going to recover. I don't know when, but I don't think it's going to be much longer than the normal averages we're used to seeing. So it's really about making sure those that need the money in the next couple of years have access to funds that are not tied to the areas doing the worst right now, so we can continue to have income without selling while things are down, allowing those funds that we have to recover, and then rebalancing along the way when appropriate. When we get a nice run, a nice bounce in the market, rebalancing and replenishing some of the cash that we took out and taking some of those recovered gains off. So that's kind of one area to look at as well. For those of you that are not retired, continuing to invest, continuing to buy the market while it's on sale is a no-brainer. Do you increase it? Maybe, maybe not, depending on your financial plan and your goals. But do you stop what you've been doing? Probably not, because now you're able to buy things on sale, which will ultimately help your recovery and ultimately in the long term be a very big benefit. So don't necessarily go take money out of cash to go put in there. This is where talking to your advisor, looking at your plan to see if that makes sense. It could be a good thing, but if you're taking cash that you might need in the short term to put into a market that we don't know when it's going to recover, that may not be a good idea. Think about it. You don't want to take money, you don't want to take cash that's in an account right now that you have access to when we may be going into a recession or already in a recession, depending on how you want to define it, and use it for investments. But if you've got your 401k, your regular Roth IRA, and you can afford to continue those contributions, then history has said that's a good thing to continue to do. So that's for the accumulators out there. I haven't forgot about you. This is it's tough to say this is a good thing and it's something you should want because it stinks while it goes on and you have emotions that are involved with it. But if you take away the emotions and you just look specifically at planning and numbers, this is a good thing for the accumulators out there. One other thing I want to throw out there that you're going to hear about is the inverted yield curve. Now, we've talked about this before on All About Your Benjamins a number of times, but basically, inverted yield curve, the reason that gets attention is pretty much every recession has been preceded by the inversion of the yield curve. So the inversion of the yield curve just means that short-term bonds are earning more than long-term bonds, and usually the opposite is true. You think about if you're tying up your money for a longer period of time, you have to be rewarded for that. You're going to expect to be paid more to tie up your money for longer term. When the yield curve inverts, that's saying bond investors don't have the confidence in the long term, that they're not willing to tie their money up for rates, and it drives up the rates on the short end. So it's basically saying we're not confident in the long-term future of the economy right now, so we want short-term stuff, and supply and demand drives the rates up. So it is a big deal. There have been times where the yield curve is inverted for a short period of time that wasn't followed by a recession, but that's why that's getting talked about as well. So that's another thing that's come in is the yield curve is inverted. So you've got rising interest rates from the Fed, aggressive language, they don't care about the markets right now, and the inverted yield curve. So that puts a lot of pessimism out in the market. Now, one thing that I don't want to minimize is how all of this feels. Advisors often say, stay the course, this is a good thing, and kind of diminish it. We show charts like this one that talks about all of the times over history you could have sold and why that wouldn't have been the right thing. Over the long term, we move up and to the right. But there are emotions that go into it, and it is scary, especially if you're listening and reading what's going on. There are narratives out there that would spook you. I still do believe staying disciplined, keeping your funds invested for the long term, being diversified is the right course of action, and making sure that you have those short-term needs covered. This is why you don't want all of your money invested. But I don't want to minimize those feelings. They're very real. But one of the reasons advisors are helpful is that we're able to help you work through those emotions to not make a decision that could potentially compound the losses that you're seeing on your statements. I hate saying it, paper losses. Gains are paper gains as well, as we've seen from last year to this year, but you don't want to realize those if you don't have to, and having the faith that we've experienced markets like this before and that things will correct themselves over time. It's just we have to give them and be in a position where we have that time. So I just wanted to acknowledge those feelings and not minimize them because they are very, very real. And oftentimes I think advisors sometimes can come across as insensitive to those. We feel those, we see those. We don't want you to not be able to live the life that you want. The final thing I'll add, and then we'll drop off because it's a little bit longer. But again, I wanted to kind of put a lot of things out there is the potential that in your financial plan in the coming years, depending on how this all plays out, you may have to make some adjustments. Maybe next year you don't take that big trip you planned on. It's not ideal, but sometimes in the plan you have to make adjustments based off of things going on. A plan is not guaranteed to give you everything that you want in your life. A plan is to say, yes, you're on track to be able to do this, but it needs to be consulted along the way, and sometimes you make adjustments. So maybe next year the trip that you take is it's domestic and not international, and you drive and it's a little bit shorter. You can still have great memories from that. And then you can get back to going international when things recover. Not saying you have to make those changes, but potentially that could be something that comes up in conversations. Okay, the final thing is, while all of this goes on, you could spend all of your time watching your statements, watching CNBC, reading the Wall Street Journal, and obsessing over the figures and the moves going on in the market. Or you can acknowledge that it's there, knowing you have a financial plan, and really focus on things you can control. One of the things would be reevaluating your cash. If your money is at a big bank, can you move it to an online bank to earn more if it's just sitting there? That's one thing you can do to maximize that. But then also realizing that this is a part of investing. You've been here before. You've been through it before. The narratives in the past were scary, just like they are now. Not to minimize what we're going through now, but you've been through these events before. You've made it through these events before. You've made it through these events while retired. So you have experience that tells you it's painful now, but it's going to get better in the future. And I think we are closer to the end of this correction and resetting than we are to the beginning. I could be wrong, but this has been going on for a year. And if you look at the market as far as growth, you go back further, we've gone nowhere for over a year. So we're further into this than you may realize, which means we're closer to the end. And the market usually recovers and begins to go up before all the pain is done on the economy, because it's looking forward and forecasting. Focus on creating a great life. Focus on doing and enjoying the time that you have with the people that you love and care to be around. And you control your perception. So focusing on the markets, focusing on the economy, and making that all you obsess about means this year has probably been a horrible year. The upcoming year could be a horrible year as well if that's all you're focusing on. If you acknowledge those and you talk with your advisor to work through them, but then focus on all of the good in your life, this is just a storyline that's going on, but you can still live a happy, fulfilled life navigating what's going on right now. Your perception becomes your reality. So yeah, things in the market right now aren't great. The economy is, going into recession, if not already there. That's a normal process anyways, and it will correct itself. So don't let that be the reason that you're not having a happy life right now. Acknowledge it, but focus on the positive in your life and let your perception be the good things that you have, the health, the family, the opportunity to be able to go do things. There's a lot worse situations out there that you could be experiencing, and focus on the good, and you'll get through this a lot easier than those that are just focused on watching CNBC all day and checking their statements daily. And that doesn't even give them the ability to do anything anyways. It doesn't fix anything. So again, not to minimize what's going on, but just making sure you shift your focus onto things that you can control and focus on the things that are good in your life. You will make it through this time a lot easier than those that are focusing on the negative. So that is it. This was a long one. I apologize, but those are things I wanted to address. I usually don't do this. I don't want it to make a big focus, but I also don't want you to think that I'm not paying attention to what's going on because I skirt over these on normal videos. We'll get back to the regular videos in the future next week, but this week I thought this was an important thing to talk about given all the headlines out there. And hopefully we just put a bottom in the market because I don't do these, and now that I did it, maybe the bottom's there. All right. Have a great rest of your day. We'll see you next week, and we'll just see you in the next episode. Have a good one.